Welcome to S&P's European Loan Market Video Overview, detailing leveraged finance trends and activity during January 2013. I'm Sujit Gupta, a member of S&P Capital IQ's Leveraged Commentary and Data Team, a unit of S&P that is not affiliated with S&P Ratings. For the next few minutes, I'll walk you through a review of recent loan and high-yield bond market trends in Europe, before winding up with themes to watch for in February and early March 2013. Before we start, please know you can follow LCD on Twitter, Facebook, and can join the over 10,000 contacts in LCD's Leveraged Loan group on LinkedIn, as well as leveragedloan.com, a free website promoting the loan asset class, and highyieldbond.com, a free website promoting the high-yield asset class. The links to our new website and to follow LCD's social channels are in the info section on our YouTube channel. You can also download the slides for this video at slideshare.net. Loan issuance was 7.5 billion euros in January 2013, while the high-yield bond issuance was 7.1 billion euros. According to JP Morgan High Yield Research, estimated inflows into high-yield funds were 1.34 billion for the 4 weeks ending January 30, 2013. And their updated number for all of 2012 now stands at 7.86 billion, or almost 8 billion euros. Secondary markets are up. Loan markets went up 208 bips to finish the month at 99.42. While high-yield bond markets are down 31 bips to finish the month at 102.64. The S&P European Leveraged Loan Index, the LE, finished the month up 1.18%, and default rates fell lower during the month. Focusing on the secondary loan market, this chart details the average price of LCD's European Loan Flow Name Composite, a measure of the 12 largest, most liquid loans consisting of 10 issuers since 2002. Even with a strong primary market, secondary loan prices rose 208 bips to finish the month at 99.42. This is the closest we've been to par since mid-2011, when the sovereign debt crisis began to affect the markets in Europe. This next chart details the average price of LCD's European High-Yield Flow Name Composite, a measure of the 12 most liquid high-yield issues since the beginning of the year 2010. The high-yield market finished the month down 31 bips at 102.64. This chart details the monthly return of the LE, a broad measure of European loan market returns that LCD calculates. All returns are ex-currency unless otherwise stated. The European loan market had a positive return of 1.18% for the month of January, up from the 0.72 seen in December 2012. It's interesting to note for the same time period last year, the LE had a total return of 2.59%, almost double the current return for this year. Now we turn from the secondary to the primary. This graph details new issue volume for both leveraged loans and high-yield bonds. January saw loan issuance at 7.5 billion euros, but more than half of this came from the 4.5 billion euro refinancing for German tire manufacturer Continental. In addition to this jumbo transaction, which was targeted at the firm's existing lenders but also expanded to new banks, the January launchpad included 10 other smaller deals totaling 2 billion euros and 5 cross-border facilities totaling 1 billion euros. January's cross-border volume is the highest monthly amount seen by European institutional investors since May 2008. High-yield bond issuance was 7.1 billion euros in January, the fourth highest monthly tally on record. This is just a touch below the 7.2 billion total seen in September 2012, which was the highest reading since March 2011's record high of 8.4 billion euros. The strength of demand allowed not only just the usual roster of popular repeat issuers to come to the market, but also those from the peripheral nations of Europe, which were unable to issue for much of last year. Borrowers from Greece, Italy, Ireland, Portugal, and Spain together raised 3.2 billion euros of bonds in January, accounting for 44% of overall volume. In contrast, the peripherals share stood at just 11% for all of 2012, based on just 4 billion euros of issuance. The default rate by principal amount fell to 6.1% at the end of January, from 6.6% seen in December 2012. The default rate by issuer count also fell to 7.7% at the end of January 2013, from the 8.5% seen in December 2012. Themes to watch for going forward. Strong inflows into high-yield bond funds, resulting in strong demand for high-yield issuers. Bond for loan takeouts will continue to keep pace. The vast majority of January's borrowers took advantage of the liquidity in the high-yield market to refinance existing debt, raising 5 billion of new bonds specifically for this purpose, accounting for almost 71% of total volume. Half of this paper, 2.5 billion, was used to term out loan maturities into bonds. This is the highest monthly tally since February 2012. We're going to continue to see peripheral issuers access the high-yield markets, and you've already seen that in January 2013. Sell-side bankers and sponsors are a lot more optimistic about M&A provided there are no unexpected shocks to the system, and there's already been a large loan and high-yield offering for Liberty's acquisition of Virgin Media. That brings us to the end of our overview. I hope you found it informative. We'll update the analysis each month and plan to have analysis of other specific European market segments going forward. Check out LCD's YouTube page for the other video analysis of the leveraged finance market, including U.S. loan market wrap-ups. The link to the page is in the description for this video. For more information on LCD news or research in Europe, you can contact Anna Cini. You can email her by clicking on the link in the info box. Thanks very much. We'll see you soon.